Okay, let's answer some questions from Sunday's Market Outlook. And from time to time, you may hear order partially filled. That's because I have my system open. It's a red day in the market, so I have some bids out for a bunch of, or offers, I should say, out for selling a bunch of puts. We'll see if I get them. Okay, totally agree about the ineffectiveness of the central bank argumentation. I'd like to add 2 points. Do you think that, albeit the current lack of effectiveness of monetary policy, in a downturn, the Fed very much has a lender of last resort function? Maybe it'd rephrase its position as having a put option function when the market as a whole fails. So you're suggesting that the central bank is going to be more effective on the downside than the upside. When I said that central bank policy or monetary policy really isn't working, I wasn't talking in terms of the market itself. I was talking in terms of the economy, because we're just seeing great economic data as interest rates went up at the fastest pace ever. I think if the Fed cuts rates in a downturn, I don't know that that really changes the economic conditions out there. It does change the repricing of assets very quickly. I just don't know that it affects much else very quickly. In his memoir, Guy's Not Dead Yet, Bernanke characterized the Fed's tools as being 90% talk, 10% real effect. Yeah, if the central bank has credibility, oftentimes they can say things to move things to where they want them to be. They don't necessarily actually have to do things. But like the boy who cried wolf, unless they actually step up and do the tough things and not just the tough talk, the market will eventually just price that in, saying, oh, that's just Fed speak. If you had to argue against yourself and come up with a bearish viewpoint on TLT, what could it be? That the Fed would hold interest rates at this level for a period of time, that inflation would not disappear and would stay sticky around 3, and the Fed would just be adamant about it, which would be a policy mistake. So I think we could bring it down to that. I think a policy mistake would slowly start to raise the long end of the curve. If the market really believed that, well, the Fed's just not going to move and inflation's just not coming down, long yields would begin to price that in. And you could get an upward sloping curve, which means you could get 10-year rates above 5.5%. I think that would be tough to do without pension funds all over the U.S. jumping all over that, and life insurance companies all over the U.S. jumping all over that. And not only that, the U.S. dollar would be so strong at that point as to start to really hurt the U.S. economy. So, if we started going that way, I'd probably become more convinced that I would. In other words, I'd be buying on the way down, but I'd be convinced about it. I wouldn't buy TLT in that particular sense if it was prolonged. I would replicate TLT with zero coupon bonds, with probably principal strips, to get the same duration. Thinking that, listen, I'm locking in, let's say 5.5, 6% return on these bonds. Good enough. You commented that the U.S. advanced financialization of the economy has reduced the effectiveness of monetary policy. It is a sort of a hypothesis I'm putting out there. But yeah, I think we have to look at that. I read an article making a different argument. It is the enormous liquidification of the financial system after a decade of QE and ZERP. What has progressively handicapped monetary policy? Idea is that when there's a large excess of liquidity sloshing around, marginal rates are progressively less effective. central bank is also quantitative tightening at the same time, right? They're also allowing the balance sheet to run off. And when you do that, that means that somebody else somewhere has to pick up the cost of that bond. So money is coming out of the banking system that way. But, you know, when your pool is overflowing with water, and you lower the level of water in your pool to the point where it's just overflowing with water, it's still overflowing with water. I mean, you really have to drain the pool a lot to start to constrict the liquidity in the pool, where you would say, I think we got a water problem here. But yeah, the amount of liquidity out there has been significant for a while. But you know, it's hard to ignore the differences between countries in terms of the types of mortgages. Canada and the UK have much more variable rate mortgages and non long-term fixed rate mortgages, but the US has a 30-year fixed. And when we look at the strength of the consumers across three markets, the US has the strongest consumer. So we are seeing and a lot less stress in terms of delinquencies on mortgage payments. A lot less. I think that you have to tip your hat to the financialization of the U.S. market over that of Canada and the U.K. So there is some evidence that suggests that if you can immunize the household against interest rate hikes, that you can get a much more resilient consumer that is, generally immune from interest rate hikes. But I wouldn't suggest that it's one thing. Usually it's a constellation of things. It's never just one thing. So you could say, well, it's this, and it's that. It's like, well, it's kind of all of it together as a constellation. You know, that if you remove one of the legs, maybe the whole chair falls. So maybe you have, four legs holding this up, whereas other economies might only have two or three legs holding it up and may not have all four present. I'm just saying four off the top of my head. It could be more, it could be less. Great point on TLT. You can do an in-out spread. June 28 put has some good skew, buying a lower volatility and selling a higher volatility. Oh, that's just a statement. Counter your thesis, the Fed will go back to the zero line due to high debt levels. As you outline in U.S. debt, no big deal video from 85-95, net interest outlays as a percent of GDP was at a peak of 2.9 to 3.15. End of 2023, this figure was at 2.4, and the CBO outlook expected to rise to 3.1 in 2024, and then 3.3 in 2025 and 2026. Okay, I see where you're going here, but we have to make an adjustment, because you can always keep your interest cost as a percentage of GDP low if you increase the G component of GDP. Right, so y equals c plus I plus g plus x minus m. So if I want to say, well, my interest cost as a percentage of GDP is 3% or lower, I can always increase GDP by increasing G and deficit spend. Massive deficits. If you go back to that period of time, you didn't have that kind of government spending. So you have to look at what percentage of GDP is G. And I can always get GDP up by getting G up and making my interest payments look like it's 3% of GDP, but really that's not really the right way to do it. So what I would suggest is to go back and remove the G. The best thing is just remove G from GDP altogether and see what interest expense is as a percentage of everything else once you remove G. Or find the lowest level of G, let's say it was 12% of GDP, and just make every year 12% of GDP. But when you're going from G being maybe 17% of GDP, which is really where it should be, right? 17% of GDP, it should be equal to the tax take as a percentage of GDP. So tax as a percentage of GDP, that is a zero deficit government. But when you start pushing up to 25 and 26% of GDP, which is G, because you're always goosing GDP, you can always make the interest rate appear to be a manageable part. So again, it's a constellation. It's like, yes, it's a big line item, but the deficit is a big line item, which adds to the debt. So if you want to keep it at 3% of GDP next year, you are forced, if C, I, and X minus M isn't coming along, you are forced to push G higher, and you can keep it there. So you would have to do it again, but control for G. But you know, it's a good observation. But it depends on how you're getting that G, how you're getting that output, how you're getting GDP. And if it is primarily from G, that's not a good thing altogether. Former JPM wealth advisor here. Wealth management doesn't follow the investment bank. That price target is from the investment bank. Wealth management just goes where the market goes, and no way they are underweight equities right now. No, I think you're right. I think you're right. You would think that they've got all of these smart people putting all of these price targets out, that there would be some kind of algorithm or system within the bank where all the units are in agreement with each other on what they're doing. Because it seems investment bank is putting a price target on the market, and wealth management is doing things that are going against the very price target that they put out, or ignoring the very information and research that the bank itself is developing. But there it is. How would you recommend someone learn more about commodity markets such as copper? Every market has an industry association. Every market. Gold has one, silver has one, copper, zinc. Pick any commodity and there's an industry association. On the industry association's website, there's usually a learning, a thing where you can learn. Some sites are better than others, but there's a lot you can learn there. And then companies' 10Ks, their investor presentations, their conference calls. There's a lot of information out there. Two questions, comments. Do you still plan on doing the Fed balance sheet video in the applied series? Working on it now. The automotive one is done and up. Working on the balance sheet now. I think I'm going to have to put it out in several parts because it'll end up being a long one. Because there are some important things we have to know. There's some big accounts that you have to be aware of. And then it's the types of transactions that, let's say the Fed did this. Let's trace it through the system. And in tracing it through the system, it's not enough to show the transactions on the Fed's balance sheet. You have to show it on the Fed's, on the bank's, and on the final, whoever the customer of the bank is. You have to show it in all the accounts to really get an understanding of how that works. So it could be longer, which means I'd have to break it up in parts. If I had a vote, I think you should stick to your current format for these videos. The other channels amount to cheap sound bites where some dude gives terrible advice and no real explanation of the thought process and slaps some ridiculous still shot on the video of a surprise shot. Yeah, I see that a lot. I think what is happening, because it's really been bothering me of why somebody with nothing to offer can get such a large audience. And I'm not that concerned about the size of the audience, but it is how you measure success. You got to measure it on some metric. They can get such a large audience, but if you try to do the right thing, if you try to actually give them actionable advice, and not even just advice, but education so that they don't need you at some point, you get these small audiences. And I think what it comes down to is videos like that, I think, give the user the impression that the incredible weight of work that they would otherwise have to do will be removed, and that it seems to them the path of least resistance. And if it seems more entertaining than educational, all the better. And I think that there are more, more than I would like to admit, probably. I think there are a lot of people that really do find some comfort in following paths where they feel that the weight of the work is removed for them. That could be it. Question about U.S. debt. At what point does it become unsustainable? Well, when it's bigger than GDP and it grows faster than GDP, that is a problem. It becomes unsustainable when nobody recognizes it's a problem. That's the big thing. Like, no matter how bad a situation is, there is light if everyone recognizes it's a problem, because then they'll work to solve that problem. But when you have elected officials who are the only ones that can fix it, when you have them not even recognizing that it's a problem, when you have crazy, stupid ideas like modern monetary theory that say deficits don't matter, then that is where it becomes unsustainable. So greater than GDP, growing faster than GDP, and no one sees it as a problem, that's where it's unsustainable. So I would say at this point in time, it qualifies as unsustainable. In the US, I don't see either Biden or Trump, if they're elected, I don't see either one of them putting an eye towards fixing this problem, because it would require tough choices. I don't see either one doing that. So at this point in time, I would classify it as unsustainable. In Canada, if the Conservatives win, I don't see them cutting taxes, but I do see them cutting spending. I just don't see them cutting taxes. So they're not going to be a friend to successful people, but they will at least start the solution, which is let's cut the spending, because you can't cut taxes until you cut the spending. So it's not unsustainable in Canada yet, but you get another coalition government between the Socialist Party and the NDP and the Progressive Party, the Liberals, then at that point I would classify it as unsustainable, because they don't see it as a problem. They've said so much that they do not see it as a problem. So there I would begin to classify it as unsustainable. It's just not over 100% of GDP yet, so it's on its way to becoming unsustainable. But the US, as of this point in time, I would say is on the unsustainable path. Well, the US, being the world's reserve currency and a Fed that is a ready buyer of treasuries in times of crisis, is there any incentive for fiscal discipline? Well, yeah, right. That's the idea. There's no incentive. Seems like the U.S. can try to inflate the debt away. They had the opportunity to inflate the debt away. When you have high levels of inflation, what you don't want to do is deficit spend. You want to use that inflation because tax receipts should rise at the rate of inflation as well. You want to use that to deflate that debt. In other words, pay that debt down. They did not do that. They chose not to, and they chose to increase the debt faster than the rate of inflation. Just not bright people. Do you think the Bank of Canada will cut rates in June? I do. June 5th, I do. Do you think that with debt levels like this in US and Canada, it's going to be possible for GDP growth to outpace the rising debt? If you start balancing the budget now, yeah, it's possible for GDP growth to outpace that. But as of right now, no. No, I don't think so. Specifically when here's why. You got interest outlays running around 3% of GDP, and you've got a deficit running 3 to 4% of GDP. So you need GDP to come in at 6 to 7%, just to cover that off, because the U.S. doesn't pay interest. It just floats more debt at each issue to pay the interest and to meet the maturity schedule. So all of that just simply adds to the debt. when most reports suggest Canadian labor productivity will never reach productivity of the U.S. No, I agree. It probably never will. What fiscal policy should be expected of politicians for this problem to be addressed? Well, your question is I don't know that that's a normative question. You're saying what policy should be expected of politicians? Nothing intelligent is what you should expect from politicians. But if you said what policies should politicians do, that's a normative question. Then you can answer that. But what should we expect of our politicians? Nothing until we expect better of the voters, and that's just not going to happen. Democracy, I think, is very broken today. Since you only use option strategies that are actually useful for most of retail traders, I'm very curious to see which new strategy will be applied to options. I don't know that there would be any new strategy. I think the big ones are covered. Do you have any specific in mind right now that you like to add to the series? Not really. I think I was fairly inclusive for everything that needed to be there. Person that does top-down analysis for investment purposes, I appreciate if you share your preferred order of going through the sector studies. There is no preferred order. I would just pick a sector that you like and go with that. Start there. Okay. You once said that we should play on a quiet residential street instead of playing on the freeway, referring to NVIDIA. How do we determine the stock is quiet enough street to play on? Well, everyone was waiting for NVIDIA. I mean, everybody. So the whole market was determining which way it was going to go based on what happened there, which makes the outcome here very curious that we've decided to sell off. Just look at the implied volatility on the puts. I mean, if you got implied volatility in the 50, 60, 70% range, that's a busy freeway. When pricing options, what is the benefit of using risk-neutral probabilities? Is because the option is a derivative. The option is priced based on the underlying stock. The underlying stock is the risky asset. The derivative is a pass-through security that passes through the performance of the underlying. So the option isn't risky. The underlying stock is risky. The option is mathematical. So there's no point in adding more risk onto the options when the options will move as the underlying moves, and it's the underlying that's risky. So you wouldn't double risk it by putting more risk into the options. Just curious, what would be your highest conviction long-term bet, 20 plus years? The market. I would, if I had to put money away and not know what was going on for 20 years, I wouldn't try to pick a sector. I wouldn't try to pick a winner. I would pick the market, period. So SPY. Quick question. When you evaluate a company, let's say Walmart, what do you usually look at before making an investment thesis? From my experience, I've used a top-down approach looking at GDP, retail sales, inflation. For something like Walmart, Walmart is a sort of reflection of the health of the economy. Then yeah, you can use that. There's not much of a story behind Walmart. It's a retailer. It buys things, puts it on the shelf, and sells things. Now, a little bit more complex than that under the hood, but basically that's what it does. So it's not as if there is something that you can look at in terms of Walmart and say it is going to grow, 30% a year for the next 5 years. That's just not the type of business it is. It'll grow at the rate of consumer spending, and that's about it. So it's really a business about probably cost control more than anything, and having the right mix of product. If retail sales and GDP are on an upward trend, I would mark that sector to be favorable for the company. Yep. Then I would look at their 10Q, 10K and evaluate their strengths to pass on inflation numbers. But what I usually struggle at is the price, which I think is fair. I don't worry too much about the price that I think is fair. Ignore price. Price is an absolute number that's not going to give you very much. Focus instead on multiples. You know, what multiple of earnings or what multiple of cash flow are you willing to pay? At what point do you feel comfortable or uncomfortable given a particular stock? But the price is, look at a multiple. So if you say, well, retail, you know, I don't want to pay more than 10 times earnings, let's say, and I'm just making a number up off the top of my head, and you think next year will be $6 a share, then you don't want to pay more than $60. And you think, well, you know, even in tough times, maybe it'll trade down to 5 times and maybe 8 times earnings. So you can say, well, $40 would be, you know, I'd be all in at $40. So you can come up with scenarios in which you can say, well, you know, if you want to steal something, if you only want to buy something at really low prices, then you'd give it a lower multiple with lower earnings and see what price that is, and maybe that's a price you want to sell puts at. Would you build the buy and hold portfolio in the Applied series the same way? Tweak it for a more bearish tilt, or wait for a better entry opportunity considering the current environment? If I had a buy and hold portfolio and I were 25, the second thing that I would have is a contribution plan, in which case I would not care at what price I initially entered, because I plan every month or every quarter to add to my position, because I have my savings contributions that I would make. So I would have a policy of saying, okay, I'm going to save 20% of my income no matter what. I will live out of the rest. And every month I'll put money in the market, and I will buy equal percentage of bonds, or 40% bonds, 60% market. And since I'd be buying on a longer moving average, I would not be too concerned at the multiple that I'd be buying. I would get a long-term multiple out of that. So it's not as if I only have $10,000 and only 10,000 and that's all I'll ever have. So I got to pick my entry points carefully. If I had a contribution plan over a period of time, the entry points wouldn't bother me. Let's see. What's your view on lithium? I have no view on lithium. Isn't this other commodity needed for EV and even for the utilities as they go more towards renewable and need batteries? There is no shortage of lithium in the world. That's the problem, is there's lots of lithium. Any company in that space you've been watching? No. No, I can't help with lithium here. Premium on TLT is so low that you won't sell puts. What is stopping you from buying long dated calls at the same strike or other strikes? Well, the premium is low on selling puts. That does not mean I have to. I have to find a way to play TLT. There are other stocks that selling puts on makes a lot of sense. Annaly, for instance, I have an offer out to sell $18 puts on Annaly for July. 51-day options, 6.4%. Why not move my capital there? Why tie it up with TLT if there's nothing really exciting on TLT? You know, and the calls will still be priced on the forward curve, and with the level of interest rates at 5% on the 1 year, or a little over 5%, I still have carry. So you know, they're just other fights to win. How do you learn to really understand a given topic about markets and economy? What is the process for you? Are the most effective ones you'd suggest? Start with a 10K. You start with a 10K, and then you look to see if there's any industry association, because they usually have a lot of good information. If there's nothing there, you're going to have to go a little bit further. There are little snippets here and there that you can pick up on. Sometimes there's government data that you can use. But slowly you start to put together a picture, and the more and more you read, the less and less you learn, to the point where, you know, you spend a couple more hours looking around and you learn nothing new. At that point, you've got your notes. Now you go through your notes, you consolidate, and then you say, okay, well, this is going a little too far on this topic, this is going a little too far, and you pare down what you have. But it starts with a 10K, and it starts with an industry association, and then as you're learning, it may seem overwhelming because everything you read is new information. Well, yeah, just keep at it, because you will get to a point where nothing is new anymore, where you're not learning anything new. It's a fast world with tons of information coming at us daily. It's not all information, a lot of noise. I don't seem to be able to learn, understand things well enough because I have to keep up with other things as well. I can only skim stuff, so I have some idea about everything that happens in markets and economies. So that is kind of like a first-year university approach, right? When you take those survey courses, it's a mile wide and an inch deep. But as you progress through the years, and especially once you go to the master's and the PhD, you're an inch wide and a mile deep. It's the other way around. So you have to focus. You're never going to know everything about everything. And this idea of being a generalist, of spending some time on this, spending some time on that, spending some time over here. You're never going to become an expert in one thing. Pick one sector, and really, really know that sector. And listen, there is opportunity in every single sector because every stock fits in one of three buckets. Sell, hold, buy. If it's a buy, well, buy it. If it's a hold, sell puts. If it's a sell calls. And if you can balance these off so that you can get a dollar delta beta close to zero, you have a neutral portfolio that generates nothing but alpha, and you can get your beta plus any, if you're really good at stuff, some more alpha here. So nothing is a waste of time. Every stock will fit into one of three buckets, and depending on the bucket, you have a strategy. But you got to focus. Otherwise, you end up here. You have some idea about everything, but a little knowledge is a dangerous thing. That's what gets you in trouble, is the little knowledge. It's how much you don't know that is a problem. So find one pool and dive deep. Going through inflation drivers model on Bloomberg Terminal, and the most recent version of it showed that it's demand that is driving inflation in the U.S. and that interest rate is not as restrictive as the impact. The interest rate is not as restrictive as the impact of high interest rates. Let me try to. The interest rate is not as restrictive as the impact of high interest. Okay, I can't make sense of that statement at all. Of high interest rates is falling month over month since January. I can't make sense of that sentence at all. Is this really the case? I don't know. Why should the Fed lower rates unless there's a massive crack in the economy? I think this sentence wasn't meant to be written that way unless this IR is referring to something different than this IR. But it sounds like you're saying interest rates are not as restrictive as high interest rates. Yeah, I don't understand the sentence. How do you scout for opportunities to trade? What news source do you look at for as well to scout these? From a top-down perspective, there are things in the economy that you can say, well, this is going to affect things, right? So the electrification of the world towards renewables, in the vehicle, in the grid, that kind of stuff, that leads you to copper. Pretty straight line to copper. So sometimes it's a macro trend that you can pick up on. Other times it's just a company. And like I say, every company fits in one of three buckets: sell, hold, and buy. So any 10K you pick up, any company you pick up and start reading about, you'll get to understand that company. You'll look at the multiple, you'll look at its history, you'll look at what it's doing, what its plans are, and then you'll decide whether or not this is something, if I had to buy this, if I had to own it, what price would I want to own it at? And when I say price, what multiple of some kind of metric would you would you buy it at? Well, there's where you would sell puts at if that were the case. But again, sell, hold, or buy. Every single company. So no company is a waste of time. It'll fit into one of those three buckets. So you come up with your own ideas. You don't have to wait for the market to tell you something, because if the market tells you something, it's going to be in the price. The moment you start hearing this company's doing this and this company start doing that, you say, oh, I think I found something. You go to the company, you find out it's trading at 55 times forward earnings. It's like, oh, wow. I mean, sure, it might be doing all of those things, but I'm certainly going to be paying for it already. During COVID, you made a video predicting DXY would depreciate in value. Your arguments were the outsized U.S. current account deficit, a couple of low nominal interest rates. With interest rates expected to decrease, perhaps go to the zero line, do you think significant depreciation DXY is on? Well, yeah, as you'll see DXY decrease in value once they start lowering interest rates. It will increase in value for a period of time because I think in the next couple of weeks you're going to see European Central Bank lower rates and the Canadian Central Bank lower rates. So interest rate differentials will widen, which will weaken those currencies and give the U.S. Relative strength over those. But once the U.S. starts cutting rates as well, then yeah, I think that begins the weakening process. Watch your seminar video about currency exchange rates in the section on triangular arbitrage. Lots of small currency dealers in the city I'm in. What's the chance of arbitrage opportunity existing there? Very, very small. Very, very small. Because all of these trading houses will have algorithms that constantly calculate all the exchange rates and will jump on any opportunity, algorithmically, will jump on any opportunity that opens up. Wouldn't it be difficult or painfully long? Oh, I'm guessing I'd need to set up a spreadsheet and walk to every single dealer and list all the exchange rates. That there's no time to do that. That has to be automated. Wouldn't it be difficult or painfully long process to detect any arbitrage? They just wouldn't exist. And we'll just leave it at that. Aim to launch a hedge fund or secure a position as a portfolio manager. To achieve this, you need a professional track record to showcase your performance. Those are not entry-level positions. They're just not entry-level positions. Are there specific software tools you recommend? Should you adhere to GIP standards, or are performance metrics from an IBKR demo account sufficient? What would be most convincing for potential employers or investors? Well, you could show your track record, including what your Sharpe ratio is. You could show that, although from the retail side it can be discounted because you can buy lottery tickets on the retail side that you can't buy on an institutional side. By lottery tickets, it means that maybe a whole bunch of your gains came from one or two really wild bets, where you bought $50 calls on a $30 stock and it got a short squeeze and you made 10 times your money. That just wouldn't fly on the institutional side as something that is sustainably repeatable. But the positions you're talking about, those are not entry-level positions. Even if you are a retail investor, those are simply just not entry-level positions. Looking into the Morningstar article you shared, looks like JP Morgan chief global equity strategist made the 4,200 price call in November. Meldrum SPY was in the 450, 460 range. Do most Wall Street firms release quarterly updates to their price targets? I don't know. I think market would want to pull in updated price targets, but maybe the majority are just updated annually. Yeah, I don't know the answer to that. I'm preparing for L3 in August. Do you think the EOC and blue box model answers are good proxies for how to write in the exam?
Order partially filled.
There you go. Which one did I get? Look at that. Order filled. Blue box, yeah, I don't think EOCQ. I think they are too wordy. How would you suggest to go about practicing real exam style structured response questions ahead of your live mock exam review sessions? Yeah, I don't know. I don't want to turn this into a CFA Q&A session, so I'm going to pass on that one. I believe I remember you saying you were depressed after your dog passed. How did you overcome that? Well, first of all, I wasn't depressed. Okay, let's not use the word depressed. I was sad. You're allowed to be sad. Depression is something different. Is where you have a chemical imbalance in your brain. You have particular neurotransmitters that are flooding your brain that give you the feeling of sadness, even though there's no reason to be sad. So it's not something that you could just say, look, you'll get over this. It is an imbalance in your brain. So you do need some reuptake inhibitors for that. You have a loss in your life. You're allowed to be sad, and it'll pass. But you can't just ignore the sadness. You gotta work your way through the sadness. It's part of being human. Time. That's the only thing that does it. It's time. And do you have advice for others going through the similar? Yeah, there's no taking that burden away from you. It's something that you're simply just going to have to internalize. And it may not sound comforting right now, but it will pass. And it's time. It's only time. But don't call it depression. Don't say you're depressed. You're sad. There is a difference. I'm sad. You're allowed to be sad. Things happen. You can be sad. I think too many people run and say, oh, you're depressed. You need some drugs. No, my dog died. I love my dog. I'm just sad. I'll get over it. So I wasn't depressed. I was sad. Documentary about 2008 crisis. In it, there was a lot of talk in the prior years to 08 that the level of financial sophistication of the banks had reached a point where they had managed to reduce their risk through sophistication, so everything was fine. Now, that might have been true, that the level of financial sophistication allowed them to reduce their risk. The problem was they weren't measuring risk correctly. It wasn't that they didn't have the tools to hedge themselves from risks. It's just that they weren't measuring risk correctly. In reality, they just moved it on elsewhere and they failed to see the systematic risk. True. They couldn't see the forest for the trees. The talk of financial sophistication sounds eerily similar to me. Yeah, it could be that most of the economy has immunized themselves from interest rate hikes at the expense of someone on the other side. Or it could be that once rates start falling and the pendulum swings the other way, everyone who's immunized themselves will now feel it may go the other way. I don't know. This is the whole issue with complexity, right? If you have a complicated problem has a solution. It may be difficult to get to, but complicated problems have solutions. So give me complicated problems, but complex problems have no solution, because as soon as you push on one thing, something pushes somewhere else. There is no solution. There's only states. And for a complex system, when you try to solve something in one place, you will have unintended consequences somewhere else. So it's never a matter of a solution. It's a matter of what's the more a desirable state to be in, understanding that any state you're in is going to have problems. You can never completely solve problems in a complex system, and the financial market is a complex system. So yes, if something happens somewhere and you rush to fix that, you could make things worse somewhere else, or move the system into a state that is less desirable. Let's see, could the idea of interest rate risk being hedged out across the board be similar? It could be. You just don't know. That's the whole thing with complexity is you really don't know. Risk must go somewhere. True. The only way I could possibly see it being removed is if the government was in effect taking on all the interest rate risk, who would never default. Well, they're not. I work in banking, in risk, and I know people are greedy and not half as smart as they think they are. Well, I think I'll agree with you there. So I struggle to buy the sophistication narrative. The instruments may be sophisticated, the users may not be. So not until you stress a system will you actually know whether or not, you know, what the unintended consequences are, but there will be unintended consequences somewhere. Now that IV on TLT is super low, would you prefer to buy long-term calls? I already answered that. How's he getting forward PE? 27 for NVIDIA. Where's he getting growth rate? Well, look, you're putting 0 growth rate. 598 was the earnings per share. You're just multiplying it by 4. And then you're growing just that at 21%. They're growing 21% quarter over quarter. So if you need to do it, this is how it looks, is your next quarter would be 5.98 times 1.21. The next quarter after that would be 5.98 times 1.21 squared, and then 5.98 times 1.213, and then 5.98 times 1.214. And it's the sum of all of that you would get if you're growing 21% quarter over quarter. What is your opinion on an index fund bubble? Well, there are inflows in the various index, say S&P 500, which can make various components in the index overvalued, or potentially making the entire index overvalued. Well, yeah, you have a point. When money comes in passively, it does not care about valuations at all. It doesn't care about price. It simply just buys at whatever it is. And because it's market weighted, if the top 5% make up, or the top 5 stocks make up 20% of the index, for every $100 that goes in, $20 goes into those 5. Regardless of what the price is, the buyer is agnostic to that. But in market sell-offs, it goes the other way. It passively comes out regardless of what the valuation is, which could cause big valuation swings. The more passive money there is, the more active opportunities there are. So let it be. Let it be that way. Make 99% of all the money passive, and I will have a good time. In a previous video, you mentioned you have a portion of your wealth managed by JP Morgan. Yep. Gone through the promotional material, hedge fund selection. They average around 7%. Pretty decent. Sharp low beta. All in all, not bad. 5-year grade. Between 5.5 5.8. Is a hedge fund path really worth the extra 1.2% extra per annum? Well, you have a point. And I'm not naive. Everything is done for money. So with wealth management, it's basis points. You know, the wealth manager gets so many basis points of your money, period. You know, and you know, tries to target a particular return that you'll feel comfortable with. If the idea was, well, why don't we just put you into these bonds for the next 20 years? That'll get you'll get 6% over the next 20 years rather than reach for 7%. Basis points here would drop to 0, and the wealth manager wouldn't make very much money. It wouldn't be in their best interest to do that. So is there a certain amount of wealth management that is driven not by maximizing the client's benefit, but by maximizing the wealth manager's benefit? Yeah, that's the world. That is the world. So in a period like now, you know, you can't just say, look, you can get 5.5% on cash. Why should you work for 7.2? It's because you have to look at a 20-year horizon and say, well, 7.2 is what we expect as a geometric return over the next 20 years. I'm not going to get a cash rate of 5.5% over the next 20 years. Those yields will disappear over time. So within this is a longer term view with a certain amount of rebalancing every month, as opposed to just having one asset all the way through. So there is some value there, but your wealth manager is not necessarily your friend. Your wealth manager is self-interested, like everyone else is self-interested. And they're in the game for basis points, your basis points. You just have to determine whether or not those basis points make sense for you. What is the ongoing management fee for that kind of service if you had JP Morgan? It depends on what you use, right? It can be expensive if you use very little, but there are other things that you get that, at lower costs, and some things you get for free. That if you take advantage of those, you'd say, well, I'm getting these things that I'd normally have to pay for. So maybe they provide research that you just have access to some internal research that that you might otherwise have to pay for. Well, if you never read it, then it has no value. But if you use it, well, then it helps offset some of the basis points that you're paying. But it really depends on how much you have, what your relationship is, and how much other stuff that you use. So that's a hard question to just say, oh, this is what it cost you. Learned the hard way by investing up to 30% of my portfolio in calls, hoping to leverage my position at that time. Most of it was TLT 2026 $100 call, smaller position XLE September 98. While I still believe the TLT thesis, considering what you said about buying calls in this environment, made me think to close my position and start over again with a proper strategy. I've been doing well by wheeling ABR, and I'm thinking of sticking to your strategy going forward and buying calls only when the timing seems right. What do you think? I think you got to do what's right for you. I think you got to find a strategy that fits your personality, fits your lifestyle, and fits your style. And I think you got to find something where you win. If you're at the craps table and you keep losing, even though you have the possibility of winning big, if you do win, but you keep losing over time, then stop playing craps. This is the problem with this game, is it's accessible. And it is a casino. It can feel like a casino that you can simply make a bet and if you buy something and it goes up and you're up $80 in 7 minutes, you cash out, you got your $80, you think that was easy. Yeah, this is what I'm going to do. This is what I'm going to do. And then you get hooked on this idea of, that it was easy, and it becomes a casino for a lot of people in the retail space. It is a casino. It's no different than going to a casino, but they somehow feel that they're in more control over the situation, that the odds are in their favor. And I will say the odds in the market are generally in your favor if you have experience in education. But if you're outsourcing your thinking, if you're just following along, or you're just jumping from one thing to another because you hear it in the news, the odds are against you. And much like a casino, if you bet long enough, you'll lose all your money. If you don't know what you're doing in this game, if you play long enough, you will lose all your money. And that long enough, usually 3 to 6 months. And I know what a blow up looks like. Is it usually ends up being one thing that takes you down. Is that you make money on this and you made money on that, and 10, 15 trades, you fought your way up, you make money, and one trade takes it all away from you. If that sounds familiar, that's what inexperience looks like. And that is what probably 90% of people who open accounts will experience in the first 3 to 6 months, is they will lose pretty much everything they put in. I'm not making that number up. It's about 90% of people who start blow up. Now they may put more money in and then they go longer before they blow up, but they may blow up again. Some people figure it out and they correct themselves and they learn from their mistakes, and maybe they don't blow up that many times, but 90% of all retail traders will lose pretty much everything they put in. They will blow up on if they treat this like a casino, and most people do. So I would say you've got to find something that works for you. Don't try to copy somebody else's strategy. Don't outsource your thinking to somebody else. You have to come to your own conclusions about what's right for you. Not related to market outlook, going through the applied series videos, one question keeps coming to mind. To invest in market, do we really need the big data analysis tools like Python? Or I never use any of that stuff. It seems to me no matter how well you understand finance, you must be adept in data analysis to do well in the market. No, you don't. No, you don't. I don't do any of that stuff. I don't do any valuation, really. The idea of doing a cash flow forecast, I don't engage in any of that because I know that anything I put on that screen is just a best guess. I'm just guessing. I really don't know. I don't have access to management. I don't have access to certain data products that might give me insight into some deeper information. As a retail investor, I don't have access to any of that. It is other than putting my assumptions down, other than really uncovering the assumptions that I'm using, it's a waste of time. Whatever numbers I come up with are just guesses, and the less experience you have, the more those guesses approach the word fantasy. They're just pure fantasy. And you become convinced that because you've done this rigorous process, it must be true, and you risk making bigger bets on that than what it's worth. Look for a story. The retail investor should look for a good story, and I think that's about as far as I would go. Oh, I'd look at some relative valuations, and I'd look at things like that, like how is it priced versus its peers, how is it priced versus its history. But I don't do any 10-year forecast. Now, if I were an institutional analyst where it does matter, then yes, I would probably over many years build out very good models on each company, but certainly not on my first sitting. It might take 2-3 years of really getting to know a company to be able to forecast within some range of accuracy. But one external event, all those models are out the window. Thanks for adding the new position section applied level. Would it be possible for you to also convey what percentage of portfolio is allocated to each position idea? For me, that would be difficult to do, to say what percentage is allocated, because I run different sleeves. So I don't know how I could report that. Plus, I have a certain amount of my portfolio that would be in T-bills, which would, if I tried to report some numbers, because of the weighting of that, it would skew the numbers. So, I mean, all I can really do is tell you what I'm thinking of doing. But as far as how I'm doing it in the portfolio context, I think that would be difficult to do, and sometimes wouldn't make sense. Maybe something like absolute DDB exposure of each position divided by something. Yeah, no, that I don't know that I could get that done because of the way that I do things. What did I get here? AT&T puts, nice. But only partially filled, you see. Appreciate transparency. Are you ever worried about copycats, front runners, or worse, someone taking a large adversarial position against you? No. It's no. It's not like I'm doing 4 million shares of a company trying to get 5% of a company, and I got to keep that quiet. No, I'm not concerned. I sold Oxy puts today. If I would have posted that I was about to sell Oxy puts, I doubt I would have moved any price on anything anywhere. But if Buffett said he was looking at selling Oxy puts, the price probably would have boosted. Someone like him can't really say much ahead of time. Whereas for me, it's not going to move anything at all. If I had 12 million subscribers, then I have to be careful. Then I enter into a different realm altogether. I'd have to be very careful about what I do. The SEC would probably have something to say about what I'm doing if 12 million people were listening to me, because then I could move markets. So then my positions and the timing of my positions would probably be looked at. But no, nothing like that. I don't have 12 million subscribers yet. Are the revenues for NVIDIA booked revenue or cash revenue? Given rules of US GAAP and revenue recognition rules, A company cannot recognize revenues until all of the what do you call it? All of the requirements of delivery have been satisfied. So there's a number of things that have to be satisfied, and if it is, then it's revenue. So it's not as if they can say, "Oh, we sold 10 billion because we have orders for 6 months from now." They can't do that. That would be called unearned revenue. Okay, what are your thoughts on lithium? Already talked about that. Explain how you got 39.40 on growth, 21% growth. Already did that. How do you feel about American cannabis companies like Trulieve and Green Thumb? I know nothing about those two. I don't even know what their valuations would be. So, and I'm not sure where the U.S. is on all of this. I don't think they're as advanced as Canada in terms of legalization of it. Want to buy call options thing? Oh, I already answered this in the live session Sunday night. Getting through these quick, huh? 2023, we all thought a recession was imminent. Now it seems like 2 years since the Fed's initial rate hike, we're in the clear according to most pundits. Where are we with recession watch? No idea. Somrol's at 0.37, for instance. No idea. It is being the oddest time for macro that you could have inflation the way we had it, up to 9% at one point, interest rates rising the fastest they've ever risen, and the economy accelerating into that. That is just not, not really. It's not conducive with the story. That if I told you that story, you'd say, well, one of your data points is wrong. So, I don't know. Question about the use of AI model in determining stock price. In some time, let's say 5 years, won't these models consume all the public information available for a company better than a human? Oh, I'm sure it will be able to incorporate much more information much faster than a human, sure. Consume quarterly results and transcripts and eventually determine a stock price, which is set at the open of trade and stays there, and therefore changing the way the stock market. Oh, do you think one model will be different from others like humans do? Well, I don't know. I don't know if an algorithm can ever develop intuition to know that when there are lots of times where a company will beat the expectations and raise guidance and sell off heavily the next day. That I don't know if an algorithm would be able to play that kind of game, or would be able to say, okay, this is the wrong move, let me step in, or would it then switch over to, would it follow the market? Or could it take a position contrary to the market and lean into it? I don't know if it will ever develop intuition. Will it know to hold back when something is going on and say, no, let's just wait. This feels like something. If you ask any really successful investor, they'll tell you, intuition plays a large part of it. That sometimes you take positions that seem contrary to what the evidence is telling you to do. Will an algorithm ever develop that intuition? So, as I said on the in the market outlook, you have AI. I think we're putting way too much weight on the I, and which is the intelligence, and a lot more weight has to be put on the A, which is artificial. It is artificial. It is algorithmic. And yes, it can take in a whole bunch of information, but it can only do what the algorithm allows it to do. It is not going to develop awareness and then begin to think outside of its code. It will live within the code that it has. So I'm skeptical that will ever get much past a heavier weighting on the A and a lighter weighting on the I. What industries or companies do you think are the easiest to fully understand for a beginner? Retail. Retail is probably the easiest because they bring boxes in the back door and they push boxes out the front door. So something like Best Buy or Walmart or Target is fairly easy to understand. Storage lockers are another easy business to understand. Really easy is that, it's, you store your stuff here. Auto assembly companies, OEMs, they're pretty easy to understand. They bring parts in one door and they send cars out the other door. Fairly easy to understand. Once you get into tech, you start getting to some business models that might be difficult to understand, but in the consumer discretionary space, most of those business models are fairly, it doesn't take a lot to figure out what Target makes money at, what Costco makes money at, right? What Best Buy makes money at. What are they doing? Now they have other little things like services, this and that, but at the heart of it, you walk in the door, you pick something off a shelf and you pay for it and walk out. So they're called box pushers, right? You push boxes in the back door and push boxes out the front door. They're easy to understand. You question the validity of the statement there's $6 trillion worth of cash sitting on the sidelines because you reckon that cash in money market funds is already at its natural destination. No, I'm not saying that $6 trillion is at its natural destination. What I'm saying is that when somebody says there's $6 trillion of money sitting on the sidelines, that's not the sidelines for most of that money. There might be $1 trillion of that that's sitting there waiting for an opportunity. But at all times, in all markets, there's always money in the money market because that's its home. That's where it lives. So, you'd never get to a point where there's zero money in the money market, because if you're saying that $6 trillion is on the sidelines, that means once the whistle blows and game on, that all that money would flood onto the field and there'd be zero left in the money market. That's just never the case. So when you hear people say, there's $6 trillion sitting on the sidelines, no, there isn't. Now, some of it might be on the sidelines waiting for an opportunity, but not $6 trillion. A lot of that money lives there. It is home. It's not on the sidelines. You reckon that said cash in money market funds already a natural death? Buffett himself said he's sitting on 168. I think it was 100 and more than that, 182, 192, because he's struggling to find value. My own broker told me that many of his customers are holding on to T-bills waiting for a retracement to re-enter. Well, T-bills is not money market funds. Right? If you're holding T-bills, that's not money market funds. A money market fund is you give your money to a fund that then goes and buys T-bills. But you're in a fund, a money market fund, not a money market security. So, holding out in T-bills waiting for a retracement, 5% risk-free. There's no rush to chase the market. But if there was a correction, I do expect some of those $6 trillion to see their way back in the market. Some of that $6 trillion would enter the market, and we don't know what market it belongs to. Some of it belongs to the fixed income market. Some of it belongs to duration. But with an inverted yield curve, I get more in cash than I do in a 10-year yield, right? Especially if I think that rates aren't going down anytime soon, I may as well enjoy cash, because why sit around and wait for duration and underperform on the yield? There are inflows into equity ETFs all the time and inflows into money market funds. So money is flowing into the market and flowing into money market mutual funds at the same time. So I don't know, to attribute, to say that markets can go higher because this money's on the sideline. As you just said in your argument, that you'd if you see markets go lower first, maybe it comes in. But that's not an argument for markets to go higher. That might be an argument to support markets on, let's say, a 10% pullback. There would be some funds that could support markets for whatever amount belongs to the equity market, which I don't think is $6 trillion. I would have trouble thinking it's even $1 trillion. 3 questions. Thoughts on Milei? Do you think his policies outlook create opportunities in Argentina? Don't know anything about Argentina, so I don't know if there are any opportunities there, but what was being done was not working, so you may as well try new things. Do you ever look at politician stock trades for opportunities? Nope. You're probably aware these are available in public domains. You think it's worth placing much emphasis on those data points? Maybe, but it's just nothing I do. Any update on MicroStrategy arb trade? I answered that Sunday night on the live Q&A. MicroStrategy investors seem to have a firm and unbreakable belief in MicroStrategy's Bitcoin trading at a substantial premium. Yeah, it's your last line is correct. It's difficult to fight a cult. It's absolutely difficult to fight a cult. But they will be proven wrong at some point. The fundamentals do show up. But if we can figure, like I said in the Sunday feed, if we can figure out why people are willing to pay a premium just because Bitcoin is sitting on a balance sheet, let's do the same thing. Let's start a business. Let's raise money. Let's buy Bitcoin and sell shares for twice what it's worth or triple what it's worth. We'll sell our own shares in the market and we can double our money on Bitcoin right away. I don't understand why Bitcoin being on a balance sheet suddenly gives it a multiplier effect. I mean, why not give cash a multiplier effect then? You got $10 of cash, I'm willing to pay $20 for that. Because you're a business and you'll just generate more cash, so I'm willing to pay $20 for your cash pile right now. I don't understand it. And I'm sure it's the same group of people saying it's a currency. Well, if it is a currency, why are you overpaying for it, right? I don't know that there's any cohesive thought in that market or any real rationality other than just probably exuberance and unsophisticated investors. Briefly explain how the probabilities were calculated, 8, 9, and 91, 1. A bit of a long process to explain how those probabilities are calculated, but you can find it at Fed Watch Tool. It's on the CME site. And if you just Google Fed Watch Tool, you'll get to it. I don't want to draw attention somewhere else, but does anyone know similar channels for Asian economies? I don't know that one. Enjoyed your short defense vids pulling apart these expert short theses using fundamental truths. Have you ever considered pulling apart some of the videos put out by supposed experts on particular topics in economics and finance? For many of them, it would be too easy, to take one of their videos and to rip it apart. But I think you got to be careful about, who you're pushing around out there. I mean, these are people who are putting out videos trying to build a business on YouTube, selling advertising, getting that kind of stuff. They're really trying to get eyeballs. So as far as getting eyeballs, they're doing a good job of it. The short one I tore apart was, this is somebody putting themselves out there as being an expert on this. So fair game. But for most of these people on YouTube, the question would be, well, why are you picking on me? Well, yeah, why am I picking on you? I mean, as opposed to picking on somebody else, I don't know that they're putting themselves out there as experts so much as, an entertaining way of talking about something they know a little tiny bit about. But it would be too easy. I'm a total skeptic on crypto, but listen to some of these guys to challenge my thinking on the subject. I find myself listening to some of the statements that are delivered with utter confidence, but are undeniably false, and wishing for someone to confirm I'm not going mad. Names like Michael Saylor, Preston Snake, Dr. Robert Breedlove. I've never heard of Dr. Robert Breedlove or the other one. Michael Saylor I've heard of, would be on the top of my list. So in a lot of cases, some people just talk their own book, right? If you are firmly convinced that something is the pathway to riches, and you're on that path and you're doing it, you're going to sing the praises of it. You're going to keep pushing it. So you pretty much have to talk your own book. So I don't know that I would listen too much about what Michael Saylor has to say. I think he has a level of self-interest in there. But yeah, I think it would be too easy for a lot of these YouTubers and a lot of the stuff that they put out. Even there's that group that does the YouTube tour. You know, there's like a dozen of them. You could probably, I'm not going to do it, but you could list off the names of these people who show up on each other's YouTube channel to try to gain, you know, the biggest audience they can. And you listen to some of the things they say, and it's very, you know, some of the statements they make are just incorrect. That wait a minute, you're saying that statement on the assumption that you just made, and that assumption is incorrect. Or it's hyperbolic statements. I think it would just be too easy, and in the end, I think I would just end up with a lot of enemies of you know. Yeah, no, I don't think I'll do that. And that's it.